Right. Welcome to this book launch of Climate Finance. My name is Marco Becht. I'm the Executive Director of ECGI, and my job is really just to welcome you on behalf of ECGI to tell you two words about ECGI in case you're not familiar with the network, and then introduce and hand over to the author of the book, Nuno Fernandes. So first of all, about ECGI, if you're not familiar with the organization, it's a global network of about 380 researchers in law, finance, and economics. And it has the tagline, leading research with global impact, bringing really the best research in the world from these researchers to anybody who's interested. Now, we mostly do this through a working paper series, which is really research papers, but we also use other formats, and books are one of them. I was delighted when Nuno approached us to ask to be the venue and the platform to launch his new book on climate finance and to discuss it with leaders. Now, why is this? I don't really have to labor the point why this is so relevant and topical. I think we all read the coverage in various media outlets about the IPCC report from Interlaken, and just in how much trouble we are going to be if we don't do anything about the trajectory that we are on at the moment, which is basically nothing, and how much work and how much urgency there is. It couldn't be a better moment that Nuno's launching this book, which is really a comprehensive survey of what finance might have to contribute. So why is this also topical? Because Nuno is really an incredible scholar. So he started off in Portugal, and our founding chair, Antonio Borges, was Portuguese, and he'd be really delighted to see this today. And he then went to the US and then to IMD, and Michel Demaré, who's going to be introduced later as the chair of IMD. I think he learned quite a lot at IMD. And then he moved on to IESE, where he is really now one of the star professors, both in terms of research, but also in terms of his teaching, having won multiple teaching awards. So no wonder that he has written this book, combining the best of teaching based on the best of research. And I'm really delighted, Nuno, that you've chosen ECGI to launch this. Now, so last word from me. We wouldn't be doing what we are doing without donors. So Patrick Bolton, who's going to speak, is a trustee of something called the European Corporate Governance Research Foundation, which supports what ECGI does, which is public good. And major donors include BlackRock, the Investor AB, and AstraZeneca. And I'm extremely grateful for them, as Patrick, I'm sure will mention as well, that they support what we're doing, which is really for the public good. So Nuno, thank you very much, and over to you.
Okay, thank you so much, Marco, and thank you so much to the ECGI for organizing this, and above all for the generosity of everybody's time to be here, including the panel speakers that I will introduce later on. So it's a pleasure to be here, and we're going to discuss really an important topic today, and I wanted to do the book launch with some friends that could contribute and enhance this discussion. I'm going to start sharing my screen now. Can you see my screen? Very good. Okay, so the idea is that from now until 6:20, the allotted time, so the next hour and 15 minutes, we're going to basically do several things. It's a book launch after all, so we'll talk about the book, why this book, what is this book all about. We'll have a panel discussion on this topic. And then we'll also have some awards. Okay, so I want to tell everybody on the video that we're going to have some awards and some trivia as we go along. So get ready and get your fast and sharp answers ready. And I will tell you more about the awards in a second. Do the official launch and tell you more about the book, and that's it. So that's what we will do over the next hour and 15 minutes. So let me start with the awards, okay? Because the awards is something you need to just figure out the technical side of this, otherwise you don't get the award. So I want to just take the technical side out of this. It's very simple. It's a trivia, okay? Very easy questions, like Trivial Pursuit kind of questions, easy ones, okay? And you should use the chat function. to answer the questions. Okay, so there is a chat function in the Zoom app that you all have, and you should use the chat function to basically do your answers. Now, make sure that your name is visibly clear, right? Because some people enter into Zoom webinars and their name is XYZ. That's fine, but if your name is XYZ and you get the winning answer, we don't know who you are, so we will not get the award. Okay, so just make sure that that the name on the Zoom call matches your real name, so that we can contact you later on, and the winners will get signed copies of the book. Okay, so that's the prize. The winners will get signed copies of the book sent to them after the webinar is over. Okay, so that's going to be the trivia, and the question could be a question like, for instance, what's the first word in page 185 of the book? Okay, that could be a question, but it's not that kind of question, but it's going to be related, kind of related with the book. So let's start. So I'm going to start with the what this book is all about, okay? And this book is really, I mean, I'm going to use other people's words rather than the author talking about the book. I prefer to tell you what the audience and what others think the book is all about, because to me, that's more relevant. I mean, I think it's a balanced book, right? It's a balanced book that looks not just at pros, but also at cons, okay? In the demand and supply of capital. Looks at different areas that confront the finance industry, okay? That's true. But also looks at corporate finance instruments from the corporate standpoint. As Stéphane Biguet, the Chief Financial Officer of Schlumberger, says, look, various financial instruments and mechanisms for anyone who wants to take action on climate finance. So that's kind of, in a nutshell, what this book is all about. What does the book contain? Well, it contains lots of evidence from markets, academic studies, around 400 papers and citations during the book, because that's really something that's very important. It's based on real academic evidence and serious studies, complemented also with practical case studies from leading companies around the world. That's another feature of the book. Balances case studies and analytical frameworks. And overall, what I tried to do was to integrate the views of companies, shareholders on the one hand, also so taking the investor side, but also the corporate side, and also the regulation side. So that's basically looking at capital from the demand for capital, supply for capital, and then the different channels through which capital goes from demand to supply. And I'll do now the first question for the quiz. So if we can now enable the chat function, just tell me if this is enabled, please, Elaine or Noreen, and then I'll pose the question.
That's working.
Fantastic. So the first question is related to this first and second quote that you see on the screen here from Kalok Shan and from Emma Navarro. It's related to case studies. Okay. So the question is, and again, the winner is going to be the one that gets closer to this number. What's the number of company case studies that are featured in this book? Okay, and I give you 10, 15 seconds for you to answer, and then we go on. What's the number of company and investors? So it's not just companies, number of case studies from companies and investors that are featured in this book. And all of you on the panel, you cannot answer because you have inside information on this, and we are the European Corporate Governance Institute, and we take insider trading very seriously. All right, so I see the answers coming in. We have Miguel 50, Oliver 25. Okay, we have several numbers coming in. You should not see the others, but I'm seeing what you have. 1,200. Okay, so that's the upper limit, I would say, 1,200 so far. I'm not saying it's good or bad. I'm just saying the numbers. 0. Okay, good. That's also a fair answer. As good as any other. All right, so 10 more seconds and we go on. So 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. Okay, very good. Thank you very much for your answers. I will tell you later on who the winner is and what's the right number of case studies that are featured in this book. So we can now close the chat function, just in case later on we're going to have a panel and there will be an opportunity for you to pose questions during the panel. But for that, you should use the Q&A function of the Zoom, where you will be able to pose your questions and also see other questions and upvote them and all that. But we'll come to that later on. All right, what's the target audience for the book? Well, target audience is practitioners and MBA students. That's kind of taking the words of my dear esteemed colleagues in this call. I used your quotes. It's for finance managers, sure. It's also for ESG experts, but it's not just for finance people. It's also for practitioners in the corporate sector, and of course, available for courses too. Now, can be for more niche audiences, okay? Yes, there is a chapter just on central banks, for instance, and what does it mean for central banks? So if you're a central banker like Mario Centeno, well, of course, this appeals a lot to you. But I would say overall, that's not really the only audience, okay? And Andrew Caroli mentioned this in a very nice way. Corporate officers, shareholders, bondholders, asset managers, regulators, and bankers. Okay? So that's kind of the target audience for the book. And I tend to agree with what my esteemed colleagues and friends said. Very good. So let me start with the why. Okay, why a book on climate finance? And I'll tell you first, it's related to the cover. Okay, and I'll tell you more about the cover in a second. The cover is is a picture taken by my daughter, actually in a ski resort. We used to ski and actually still ski in Switzerland, but it's a ski resort that over the 10 years we lived in Switzerland, it was becoming less and less snow every year. So we could definitely see the effects of climate change affecting our family holidays. Okay, then the pandemic came. Okay, and during the pandemic, those of you that attended my presentations or workshops before, or simply visited my place, you know I'm crazy for Lego. And during the pandemic, what we did was we built all the Lego sets we have at our place, and I built like 50 Lego sets all over the house, from Harry Potter to Star Wars to invented things. Now, when the Lego sets were over, I had to do something. Okay, and that was climate finance. Okay, so that's really the why it started there. A little bit more serious. I'm on the board as an audit committee member of the European Investment Bank that relabeled a few years ago as the European Climate Bank. So it's the EU bank. And so pretty frequently confronted with things related to climate risks and climate opportunities and what does this mean for the financial industry. And then in different conferences and courses I was doing over the years, I always had the same question, or increasingly more questions from managers, investors, and executives coming up with questions related, should I do this for my company? Should I issue green bonds, yes or no? On the asset allocation side, pension fund managers asking, okay, should I go for green products, ESG, high ESG, low ESG? So I kept getting different answers or different questions from different audiences on this. And therefore, I said, look, there's lots of great information scattered out there. There is hundreds of research papers out there, but there is no consolidated view on this. And so let me try to do something which is curate all this available knowledge out there and come up with something that is readable and for everybody. That was kind of the idea for the book, was kind of demand driven with some knowledge sharing coming about. Chapter 1. What's chapter 1 all about? Well, chapter 1 nails the problem and says, look, what's the problem? Physical effects of climate change. And I'm showing you here just the subtitles of the different parts of the chapter for you to have an idea of what each chapter is all about. How we got to the Paris Agreement, and then overall changing expectations from different stakeholders. So this is kind of nailing the framework for all the other chapters, because along the other chapters, what we're going to do is look at the corporate balance sheet in the debt side, the equity side, the asset side, and then we look at the capital market dimensions of this. So if you think about the book, it has a corporate finance part, which is the debt side of the balance sheet, the equity side of the balance sheet, corporate governance as well. And then we move to the asset management side of the world, which is the investors, how investors think about that, also with a chapter on global regulations. And so definitely a topic in the agenda of top level CEOs, investors, and the whole investing value chain. For sure, consumers care about this, banks care a lot about this, and regulators as well. I mean, some examples of quotes that we've all seen, I mean, goes from Larry Fink to Christine Lagarde to Jasper Brodwin of IKEA, right? It's really, it comes from the corporate sector, the financial sector. It's not exclusive to any. Then we have the United Nations SDGs. In addition, we have the Paris Agreement, which most countries have signed or ratified in one way or the other. And that brings us to chapter 2, right? What does this all mean in terms of measuring and valuing climate effects? So in chapter 2, we talk, okay, let's move now to economic and financial consequences, right? For instance, at the corporate level, what does this mean? Well, it can, for instance, mean there are assets that will be stranded. What does it mean if your assets are stranded? Meaning you can no longer use those assets because, say, reserves. Physical risks, transition risks, stranded assets and opportunities, because it's not just about the risks and damages, it's also about positive side and the opportunities. So that's what chapter 2 in a nutshell is all about. And it boils down to what does this mean for valuation, and put all this together in a valuation methodology, let's say. Give you a little bit of idea of this chapter. It's not just at the company level, it's also at the supply and cost of fund that there are implications. It impacts cash flows for sure, because companies can be significantly impacted in their operating business by climate effects, either the physical risks or the transition risks. But it also affects the whole value chain. Suppliers and consumers are affected. So this is not just a pure, let me look inside the company, what happens? No, let me look across the whole value chain, for instance, suppliers. And this chapter 3 is about the debt side of the balance sheet. Chapter 3, we talk about different products, and we'll talk more about this during the panel, so I will not go too much in detail. Green bonds, sustainability-linked bonds, sustainability-linked loans from the banking world. What does this mean for credit rating agencies, Moody's and S&P, when they rate companies? What's the implication of this for corporate ratings, project finance, and supply chain financing? Okay, and this links with what I was telling you on the whole supply chain, because we know that emissions, if we talk about emissions, which is one part of climate, is a big part is emissions. There are scope 1, scope 2, scope 3 emissions, without going into the technical side of this. Scope 1 is really what you do on your own as a company. Scope 3 is taking into account all the value chain. So let's say scope 1, if you're an automobile company, is how much emissions do you generate when producing the cars yourself in your plants. Scope 3 is how much emissions will your cars generate when consumers are actually driving them. Okay, so that's kind of the idea. Your suppliers, your customers, what's the whole value chain? And there are very interesting financing mechanisms coming along, like this example of Walmart that I have a small case study in chapter 3, which is about Walmart's supply chain financing program. So how Walmart uses some clever finance tools to actually make this cascade through all their suppliers, more than 1,000 suppliers, how they cascade their sustainability credentials to the whole value chain. All right, so we're halfway, and I'm going to go very quickly over these next few chapters, just give you an idea. Chapter 4 is about the equity side. Start with the private equity, IPOs and SEOs. What does this mean, climate for corporate governance? Shareholder activism and engagement, which is a topic we're also going to discuss later in the panel. M&As and family firms. Okay, some examples of things covered in this topic are, okay, institutional investors are on the rise. We know that large institutional investors like BlackRock or State Street or Vanguard, they are common names in the ownership record of most companies worldwide. Well, they vote, and they vote on resolutions. So it's very important to know the behavior of these large institutional investors. And it's very important to understand that there is a significant larger amount of proposals that are related to social and environmental issues coming up in companies worldwide. So this is something that definitely shareholders care about. It's getting into the general meetings of companies very frequently. And this has, of course, corporate governance implications. Chapter 5 is about the capital markets role. And so here is about, there's lots of different ways in which fund managers can drive change. Well, we need to know a little bit about ESG ratings in order to understand the investing world. We need to understand also ESG stock market indices, because these are important drivers also of investment. Then chapter 5.3 talks in particular about the performance of green products and strategies, climate risk for institutional investors with empirical evidence from many different investors. And this is just an example of the relevance for institutional investors. As Patrick said in his endorsement to the book, more than 40% of the world's money nowadays is managed with some kind of sustainability or climate consideration in mind. And so this is the principle of responsible investment grows over time. Now, it's important to know that not all ESG strategies are the same, okay? And this is something that I discussed quite lengthy time during the book, the different strategies, what's exclusion, what's best in class, integration, thematic, impact, and all that. And also, we live in a world in which sometimes people like, it's what I call the Stevie Wonder world, okay, which we are the world, we are the children, live happy ever after. Well, be careful, right? And chapter 5 talks about this. Be careful with exaggerated statements that, yeah, you can do well and do good for the world, right? I mean, everything you do that is green is going to make you money and do good for the world. And plus, if you're an investor, if you can choose green stuff, your returns are going to be fantastic. You're going to outperform all the benchmarks and you make free money out there. Well, I'm sorry, but that's not really true. And the evidence doesn't support that. And so that's something that we also talk quite a bit in the book. And there's plenty of research done on this. And Patrick, who is going to share more later on, is one of the leading authors in this space. Risk, as always, is correlated with returns. And so we must bear these two principles in mind when we think about exaggerated statements. And chapter 6 is about global public sector responses, about the just transition, the political, economic aspects of this, dealing with these externalities that we're dealing with. It's about non-financial reporting and disclosures, all these different initiatives on reporting, materiality, the TCFD and all that. How are they playing along together? The need for convergence across global regulations and the role of multilateral development banks like the World Bank, the EIB, or others, and the role of central banks as well as regulators, as monetary policy setters, and other roles. Okay, so I've exhausted my time, and I'm going to go quickly to summarizing what the book is and is not. Well, it's about finance plus climate, of course, it's in the title. It's about best practices, but it's also about raising the awareness of readers to the developments in progress, because we are not still in steady state. We are developing. This is work as we go along. Things are being developed. I try to curate basically the most relevant academic studies and from the most prestigious journals, so that we don't just have vague discussions on topics, that they are fact-based. And it's for different audiences, as mentioned before. It can also be used as a course textbook for different academic levels. What the book is not about? Well, it's not about saying everything you do is great, green is good, right? And plant trees, you make money, and the world is better. Not really. It's also not a book about reinventing capitalism. Okay, I believe that we have a great system, and we need to work within the system we have, with the investors we have, with the frameworks we have, with the channels of linking investors and companies that we have. But sometimes we need to evolve and adjust and incorporate additional elements that now we know are relevant. It's also not a book just focused on investing. Okay, there are some books just focused on the investing side of this, including the CFA has just a book just on investing in sustainable assets. It's not about that, and it's also not a book, a Stevie Wonder kind of book, as I was describing before. So 6 chapters. There are more than 80 contributors, and I would love to thank them all here by name, but I cannot. We don't have time, but they're all deeply acknowledged by me. They're deeply acknowledged in the book, and I thank you all, because this was really a collaborative effort. I engaged with around 20 people, sent them an early draft. I got early feedback, and then each chapter was revised by around 10 persons, different people, both academics and practitioners, and this basically made for a very much sounder book than I had envisioned in the beginning. As I said, besides the academic references, there's lots of case studies. I will not tell you the number. Remember, this was one of the questions. And there is lots of real data throughout the book in different state-of-the-art, like the ones I was showing on investors. All right, so let me pause here now, and then we're going to move to the panel. and I will introduce the panel as we go along. So we have a fantastic panel now. I'm going to introduce the three speakers, and I'm going to ask a couple of questions to each, and then we open up for the audience to ask questions as well. So the idea is we're going to start with, let me just now open my, stop sharing. All right, stop sharing now. Share. I'm going to start with Michel Demaré. Michel is a very old friend of mine. We got to know each other when we were when I was at IMD, indeed, as Marco said in the beginning. And thank you very much, Michel, for being here and for all the help, and besides your fantastic testimonial that I shared earlier. We worked many years together with his, at the time, company at the ABB, and then later on many times with my own students and programs when Michel would come over as a guest speaker. Michel, I would like to introduce you, and then I'll ask you a few questions. So what's Michel? He's now the chairman elected of AstraZeneca, of the board of AstraZeneca, where he's also a non-executive director so far. He's the chair. He's also a member of the board of Vodafone, of Luis Dreyfus, and he's the chairman of the foundation and supervisory board of IMD. In the past, and I'm pretty sure that you are, that we are, I mean, I'm very thankful, at least, I don't know about you, and I will not ask you that, but I'm very thankful you are no longer the vice chairman of UBS, because if you were the vice chairman of UBS, you would not be with us today for sure. I mean, so thank you very much for not being anymore the vice chairman of UBS. And you were the former CFO of ABB and Baxter as well, and many different other positions in Dow Chemical, I'll start with one question, okay, which is, as a former CFO, Michel, and let's start with that because this is a finance book. As a former CFO, how do you see this field? What does this mean for issuers? Okay, so let's start with that. For issuers, for corporates, what does this mean? I mean, climate finances. How do you see this as a former CFO?
Well, hello, everyone. Maybe let me first also say a word about Nuno, because indeed we know each other now back for 20 years or so. And if I'm today the chairman of IMD, I think it is also because Nuno really gave me the passion for that school. As he said at the time, I was CFO of ABB. We were sending cohorts of managers to IMD to get, you know, the executive leadership programs. And so I traveled a lot to Lausanne to basically work with Nuno and some other professors to write case studies. And from the start, I found Nuno was a very inspiring professor, very pragmatic, had the great way to translate finance theory into practical case. And I think this has also transpired through his books. I was already consulting him on his first Finance for Non-Finance Executive, where he was really teaching finance to those who didn't really have the language. Now he put it even a level higher, because now he's teaching ESG to finance people and finance to ESG people. So I look forward already to the next book on that. Now, on your question, I will maybe surprise you a little bit with my answer, but I think my first reaction as a former CFO is maybe finally, because at the end, I think that there's sometimes a wrong perception that up until recently, companies didn't care about climate change impact. In fact, what was really difficult for us, CEO and CFO, was that our investors really didn't care too much. And, you know, most of the targets were financial targets. And if your CEO would spend a bit too much time talking about other things than finance and market share, he or she would be accused of getting into soft topics. And the first quarter, the earnings were missed. Probably would be asked to go because he or she was too much focusing on topics that were not totally business related. So I think that once asset managers and the financial investor community in general started realizing that their next generation of clients would basically progressively increase their share in sustainable or even not invest in things that are not sustainable, I think there was a wake-up call. And nowadays, if I see, for instance, up until recently, I was the chairman of the remuneration committee of AstraZeneca, and most of the engagement I had with the shareholders, I would say probably half of the time is about ESG and how we use compensation, remuneration, as a way to push our executives even further on that. So it has been a remarkable reversal of trend. And I think the major lesson I've taken from this, and CFOs, we always want to have return on investments in everything we do. Well, here it's a bit different. For me, the return on investment of ESG is basically license to operate. And that is a very important concept, I think, to pass along, because you can't measure it all the time. It has to get progressively into the DNA of how we do things in the company. And if we don't do that, we just won't be there. You are muted,
Yes, I'm muted. Thank you so much. Thank you so much, Michel, for this. And let's move now to Cristina. Okay, and from the banking world, so I'm going to introduce Cristina in a second. Cristina comes from, let's say, the more banking world. So she's now the managing director of Banco BPI, responsible for sustainability. And she started this role in November, so 4 months ago. Before that, she was for 8 years the CEO of the Portuguese Sovereign Debt Management Institute, so the Debt Management Authority. And before that, she was an executive director and chief economist at Banco BPI as well. Nowadays, she's also, besides the banking position she has, she's also a non-executive trustee at the Gulbenkian Foundation, and she's a lecturer on credit risk management and has a regular column in a local newspaper. So, Cristina, thank you so much for being with us today. And I would like to now pose a similar related question, but from your perspective to the financial sector and banks in particular. What's the relevance of this topic?
Good afternoon, everyone, and thank you very much, Nuno, for inviting me to discuss this topic, which is very, very relevant. And one of the things that I also like to refer or to mention is actually related with what Michel has just mentioned. This is something that has been going on for a long period of time, but there was a bit of a disconnect between what managers were doing and what they were being asked to do by investors. So I think that this disconnect has now been kind of bridged or has narrowed significantly, and I think this is very fortunate that we have kind of our views a little bit more aligned than we had in the past. And I think that the fact that these days all the externalities that climate change involves became much more clear to everyone. I think this was the trigger to align these interests. And given also the fact that these days European Commission has taken on itself the role to propel curbing climate change and making the Euro area and a net zero economic area by 2050, they had to choose an instrument or a tool to deliver on this objective, and the financial sector was kind of elected or chosen to do that. And because it's kind of was the easiest route to follow, in the sense that given that finance is key to economic activity, and then also you had, in order to fund anything, you also need to go through you go through all the projects and to validate them and to make sure that they comply with a number of rules or that they actually are viable. And so the viability of the project these days doesn't belong only on the quantitative. They don't rely only on quantitative indicators, but also in qualitative ones. And I think here, this is a major breakthrough, a major change in terms of the mindset, because traditionally we only focus on available data, And now you will want to see more what people really want to accomplish. And this also builds on the idea of it's not enough to know the company, but we will also need to know what they do and how they interact within a larger ecosystem. So you have to be more aware of the value chain. You need to understand and it's a sort of accountability that you have has also been enlarged significantly. And the fact is that these days it's the kind of the banking sector that is pushing in this direction in terms of higher oversight. I don't say oversight, but a little bit more scrutiny of what companies do. And I think one interesting feature in your book is the fact that you offer a large number of case studies, and you also try to, in the end, you also bring the public a little bit of a public perspective. So something that there is an overall a layer on top of everything that is the authorities, being the European Commission in Europe or being the central banks, that are actually pulling everything together, are putting everything together, and are also pulling everyone in the same direction and keeping also everything on track. And but because we are still in these despite the fact that you have all these products quite relatively ready in the shelf, and you can kind of deploy them quite more or less easily in the market, there are still kind of some missing pieces in this puzzle.
Let's wait for that. Let's talk about those pieces of the product in a second. Okay, Cristina, I'll come back to you. I want to go back to Michel and do basically another round with each one of you. And first with Patrick, of course. And then Patrick. So Patrick, thank you very much for being here once again. And Mark already introduced you as part of the ECGI network. Patrick is a professor of finance at Imperial College in London and a senior advisor to the Lazard Climate Center. He's a past president of the American Finance Association, a fellow of the Econometric Society, the American Academy of Arts and Science, and a corresponding fellow of the British Academy. He has co-authored Contract Theory and very much related to this topic, the Green Swan, Central Banking and Financial Stability in the Age of Climate Change in 2020. Patrick, so I don't know, we have some sound coming up. Somebody's not muted. Can somebody mute themselves? All right, Patrick, let's start with the broad one, and then we'll go into more detail in the second round. But as a professor, okay, how do you see this field of climate finance? And you were one of the people that has worked the most in this field and has published very important contributions. As a professor, how do you see this field of climate finance or sustainable finance in general? How do you see the developments? And let's start probably with that before we go to more institutional investors discussions.
Yeah, thank you, Nuno. It's really a pleasure to be here and to help in promoting this wonderful new book that you wrote. So, COVID hurt a lot of people. The lockdowns have been tough on many people. COVID hurt the economic activity. But there have been some good things coming out of COVID lockdowns. One is that carbon emissions went down as the economy was shrinking. And the other is that it made time available for you to write this wonderful book. Yeah, congratulations for this major achievement. So, climate has been a big topic in economics, and there have been major books written on climate and economics. For example, the book by Gernot Wagner and Martin Weitzman, The Climate Shock. And there've been a lot of really excellent books on the science of climate change and how the climate has changed There's a recent book that came out this year by Peter Frankopan, for example. But there hasn't really been a book on the area that you're covering in your book, or very few, let's put it this way. And climate finance is really very central to how we in the world, societies, can tackle climate change and how we can combat it. So your book is really very important, and it really offers an entry point for many people who are now really grappling with this issue. So, as Cristina mentioned earlier, there's really been and also Michel made the same point. There's been a sort of a change in the mindset of investors, and I sort of put that back to something you mentioned in your introduction, the Paris Agreement of 2015. So what was really special about the Paris Agreement, something, of course, it brought everybody back around the table. All the countries were now engaged again, but also Paris really initiated a process where it engaged with broader communities than just policymakers and governments, countries. It said this is also an issue for the private sector, for investors, and it engaged with investors. It launched a fundamental transformation of the financial industry, and I think you're picking up many of these developments in your book.
Thank you so much. Thank you so much, Patrick, for the kind words, for your help and contribution, and for the support, and for your presence here and answer. So let me go back to Michel. Michel, now, after being a CFO for a number of years and for many super successful career as a CFO, you've turned and you've moved into more non-executive and board position. Okay. And I would like to take the opportunity that we have a very senior and very experienced board member, prestigious companies, as was described before here in the panel, to ask you, as a board member, both before as a board member of financial institutions, but now as a board member of non-financial institutions, what's the relevance of the topic, and how do boards look at this? What's the relevance of this for boards? Can you share a little bit with us how boards think about this and the climate issues that are most relevant for top managers and boards, in your view? You're muted, Michel.
My turn. Yes, I could do it. Obviously, I'm maybe not so qualified anymore to talk about boards of financial institutions, because I left the board of UBS in 2019. And, at the end, this is a pretty recent phenomenon. They say the acceleration of focus on sustainability. So I remember the time we mainly discussed how to adjust our products, to meet this new demand. But if I look at the other boards I'm on, and what I hear from the industrial world, it has really gained a lot of importance. And you can see that, for instance, in terms of governance. If you look at board governance, many boards in the past had an ESG champion, so one person that was a little bit more specialized than the others on the topic, and that we would always refer to each time there was a question about that. We then, in fact, now have moved to most of the boards now have appointed a new committee, where you have really a sustainability committee taking care of all this, which doesn't mean also that it is addressing all the aspects, because it's getting, as usual, complicated. The regulators are getting in, financial accounting boards and all this. And so at the end, I believe the good governance today in a company is to have a sustainability committee that really look at the strategic deployment of ESG initiatives, and especially, as I did before, the embedding of this initiative into the day-to-day business decisions. That is a very important one. The audit committee will take care of the ever-growing issues of measuring and reporting. And then the compensation committee or the remuneration committee will also address the fact that we try to put some KPIs of ESG into the variable comp of our executives, so that we make sure that they drive the right thing. So you still have to specialize. It becomes a big issue. And as much as I am happy to see now how much time we spend discussing ESG strategy, I'm also sometimes getting a bit concerned about the time we discuss about how to accurately measure what we do, and especially the reporting. You get more and more guidelines, it's getting more easy, it's getting more and more complicated. I think for the audit companies, the next big thing now is to be auditing all the statements made by company on ESG. And I'm just afraid that sometimes it paralyzes a little bit the actions. There's so much to do. You know, scope 3, for instance, is so difficult to quantify, but we all know the path and the direction we have to take. So let's not wait until we have everything perfect before we start moving. So I think that's an important one. And the second aspect that I believe is quite important too is that everybody has something to contribute. There's also a bit of tendency nowadays that companies, industry sectors that are, you know, obviously taxed as bad, oil companies, cement companies, you know, nobody wants to hear about them. In fact, if you think of, for me, it's always a journey. And the potential improvement to the global climate change that an oil company can do by progressively reducing its emissions compared to an industry which maybe is very low emissions and brings them to zero, maybe the former is a bigger contribution, but they are a bit now, let's say, blackmailed, and we have to make sure that we give them as well an opportunity to shine because they have a lot to contribute.
Thank you so much, Michel, once again. And Cristina, let's talk now about products. You were starting to talk about this. If you can briefly, very briefly talk to us about how do you see the development of new products from the banking world perspective? What are the novelties that we should be familiar with related to this? Well,
you actually did a pretty good job in chapter 3 of your book. You kind of list, I think, all the relevant ones, the ones we can't miss. So yes, you have green bonds. I think that you have the green bonds, you have the sustainability-linked bonds, you have the transition bonds. But I think what's interesting about these new products is the fact that they bring more transparency to the process, first of all. So, and these, as Michel was saying, that ESG these days also involves much more accountability, and that comes with that is the result of reporting. But you also need to take in consideration that you also need more information, and in order to make good on the promises or the pledges that you do when you issue a green bond, the level of, you have to commit that the proceeds are adequately used, and then you also have an additional layer of responsibility that is impact. I think that we are moving from not just doing, as you mentioned in your book, it's not do well and do good, but more than do good, assess that you do good. Just not kind of write a check and get on with it. And no, you really are responsible for your actions, in the sense that you, in 2 years' time, 5 years' time, 10 years' time, we are also, you need to be accountable for your decisions, or for the project itself. So, for instance, in its implications, and not just the more traditional ones in reduction of GE or reducing pollution, but also the fact that it needs to be just. So, one point that was also mentioned before is that there is the need not to leave people behind. So, this needs to be a very encompassing ambition. But still, these means that we are, the financial industry is kind of opening up to other skills. For these days, if you need to go through if you're familiar with the technical screening criteria that you need to abide by when you under the European green bond standard, you need to see that it's not something that practitioners in the financial market are familiar with. So we need to bring different skills to the market. and our kind of opening up for different visions or different perspectives. I think that is very constructive, because sometimes I've been living in the financial market since I started my professional life, and sometimes I think we are too much immersed in our jargon, in our numbers, and we need to kind of open up a little bit. And I think this will be a very good development. But with some, as every rose has some thorns. One of the things that we really need, this is challenge that we'll face, is about the data, and we struggle with data. And you that are also involved in the central with central banks in an auditing capacity, you know that, and you have the latest reports that ECB has just published. And these days we still rely too much on proxies. But the thing is not just the proxy that we rely on. We also need to be open to different sources of information. So and more cooperative ones. So we cannot rely only on the information that is sourced out by the client or by the company. We need to rely also in kind of more open sources of information. And so this also opens up to different technologies, to different suppliers of information. So I really think this is climate finance is a breakthrough also in that sense. So we'll also push for also a bit of a technological shift in terms of how we compute our data, how we source it, and then also how you look at it, and if we have time, also the way the ratings are relevant here, and we definitely have not reached a steady state there. Right. So it's still evolving. And just one last word on the book, because I think that this idea of learning by doing is very evident. It's something that comes across in while reading the book, and this is something that is really what we are facing today. And you also mentioned it in the introduction that it is still very much work in progress.
It is definitely work in progress, and there's a lot of challenges with the data, and that connects very well with the next question, which is for Patrick, which is person that has done amazing amount and quality research on this topic, namely from the institutional investor portfolio side and the carbon footprint of the investors' portfolios and all that. Would you share a little bit with us related to the institutional investors world? What are the key things you would like to share with us on that front, Patrick?
Yeah, and before I do that, I want to pick up on 2 points made by Cristina and Michel, which I'm 100% aligned with. So I saw a presentation of the UN representative for the private sector preparing the Paris Agreement. And he made the following statement to the at that time, this was still very new. He made the following statement to the financial industry. He said, when it comes to climate change, we're all players, we're not spectators. And I really like that formula. Everyone has to do their share. So it's not just that everyone's involved, but also everyone has to do their share. I think that's the spirit of how the industry, the financial industry, is approaching climate change, climate mitigation, and so on. Now, to your question, I also want to pick up on another point that Cristina made. So, yeah, the industry has developed these indices, ESG indices, low carbon indices. And when you look at what is reported on those indices since they have been introduced, MSCI has introduced many of those. When you look at what they report financial returns. And they say, oh, our ESG index performs better or worse than an industry benchmark, like an MSCI Global or MSCI Europe index. But to what Cristina said, what we really need is we need the information about how the indices also perform on impact, how they reduce climate impact. That should also be reported. So you don't just want to focus on the financial performance, you want to focus on the impact performance. We need more of this kind of very concrete, very simple data. And I think that would make a big difference. Now, you know, I think some of these ESG indices did pretty well financially, but you don't want people just to stop there. You want to understand what is in those indices, how are they constructed, how do they help reducing environmental impact.
Thank you so much. Thank you so much, Patrick. Okay, so we are on time now, and I would like to now open the floor for questions from the audience. So you have a Q&A box there. If you can type your question, and ideally to who the question is addressed in terms of our panel speakers, or myself, but mostly to the panel speakers now, and then I'll answer other questions myself later on. And so if you can just write the questions down, and you can also see other people's questions. If they are there, you can just upvote them, okay? And all right, so I'll start answering a few of the questions here, which I think are more for myself. Is there anything on markets? Sai asks the question, is there anything on markets, in particular carbon trading markets? And then the question related to carbon trading. So yes, there is. In chapter 6, I cover carbon trading markets and describe the main ones that exist, the different ETS systems around the world. But it's not a book about carbon trading for sure. But I talk about the carbon trading and carbon trading markets and some of the problems that we face by currently not having a single price of carbon across these markets. Okay, you have lots of markets. Some are emissions-based, some are just tax-based. And I also talk about subsidies and the just transition. So yes, you will find that there. Okay, so the second one is the same. Very good. So let's go to the all right, so a question for Patrick. If you can share some of the ways in which we can actually put transition more into the indices, okay, to report the impact. And if there are any examples that already do this, okay, so transition the indices to get more into the impact that you were saying before.
Yeah, so what I've been involved in recently is the construction of what's called net zero aligned portfolios or net zero aligned indices. So the idea is that if you are an investor who wants to be net zero aligned, let's say a passive investor, an index investor, how how would you do this? And one idea that with my co-authors we've developed is the idea that you have as an investor, you have a share of a global carbon budget that can be spent from today until 2050. Every year that passes, of course, as more carbon is emitted globally, the budget shrinks. The goal is you don't want to go beyond the limit of this budget by 2050. Okay. Now, if you want to be a responsible investor, you might say, okay, I will hold to my objective of being net zero aligned, even if the rest of the world isn't, right? What that involves is that you may have to divest from some companies that are not doing their share at some point, yeah? And so then the question is how best to divest without taking too much risk. And you can do this, that's the good news, by essentially divesting within each sector, gradually divesting from the companies that have the highest emissions. So you keep sector balance, you have low tracking error, you can be responsible, net zero aligned, and yet not take too much risk, right? And that has many good properties. Also is a signal to companies saying, if you have too high emissions relative to your industry, we will invest less in your company. So it has a lot of good properties.
Thank you so much. Thank you so much, Patrick, for the. All right, so now there are a couple of questions, one for Michel and one for Cristina, and I would appreciate very quick answers. Cristina, how can climate risk at the bank level be measured? Okay, let's start with you.
Well, there are these days. I think it's one of the elements that I would like, that I think are worth raising here, is the fact that there is no common approach, in the sense that although the supervisors and the regulators have established some kind of ground rules, but it's still something that is evolving. And well, if you try to, and unfortunately, you try to get hold of the available information. So you still rely on GE emissions in some cases. For households, for households, you also, and in terms of mortgages, you also relate to energy efficiency certificates. You also take geographical georeferencing. You also take in consideration public information on severity and probability or frequency of floods, of earthquakes. So it's a plethora of indicators you rely on, and then you also have some specificities regarding some industries. For instance, you have cement, infrastructures, defense, real estate, agriculture, that have some specific indicators that you've, or some metrics that you follow. But I think what's relevant here is that until now, and despite the fact that the central banks and the auditors are trying to come up with standards, we still don't have standards. And so when you have a bank saying that in terms of scope 3, and if you focus on the loan portfolio, it's still very difficult to have bulletproof comparability. Very good. Which makes the process much more complex, because every sector is a sector, every bank is a bank, and you still have a lot of subjectivity in influencing your analysis and the way you actually compute climate risk.
Thank you.
I think most of it's as I said, it's still we are still learning.
And final one, and still learning, and I will show you a picture that captures a lot of what Cristina was saying in a second when we go back. But final question from the audience that we have time for today, because there are lots of great questions, is for you, Michel. So it's based on your experience, and it's related to accountability and implementation. What is the function that is in the best position to lead ESG reporting within a company? Muted again, muted.
Yeah, that will be a short answer. I think it is a finance function. At the end of the day, you have to do reporting, you're going to be audited. Fact is, the audit companies have taken over sustainability auditing too. We know how to comply with regulations, how to adjust. So that's why I say there's different activities within sustainability, and reporting is clearly the finance one. Nuno, if I can, I would like also to quickly answer another question, which is how do you assess the potential for collective action on climate change within the private sector? I think it's a very good question, because to me, in a way, sustainability has become a big federator within industries. If you think of scope 3, at the end, scope 3, we cannot do it alone as a company. We have to collaborate with all the actors of our industry to put pressure on the suppliers, on the customer, to basically make commitments and live by the commitment. So I don't think there's been any instance in the past of another theme that has so much federated companies within an industry together. So I think the potential for collective action is, to me, one of the big recipes of success for what we're trying to achieve here. You are muted.
Now I'm the one muted. Very good. Thank you so much, Michel. And let me take this opportunity to thank the three of you. Fantastic panel. We definitely could continue here for much longer, but we want to respect the time that we've asked you to start and that we asked our participants in this webinar. So let me start sharing my screen back again. And before that, I'm going to ask the second question, second possible question for you to win a book award. Again, put this in the chat. Answer in the chat, and the question is now related to data. We were talking a lot about data and availability of data, and the question is related to the data available in the book. Okay, how many tables and figures exist in the book? So how many exhibits, tables and figures are in the book? Please type it in the chat box. And again, the winner is the one that is going to be closer to it and gets a signed copy of the book to be shipped later on. Okay, I see the answers coming in. Very good. Meanwhile, let's start sharing my screen. Okay, so 10 more seconds. How many exhibits and tables are in the book? That's the... All right, so very good. So just on the question related to valuing risk, and just want to comment on chapter 2, which is the chapter where I focus on risk model. And share an example. There are several models, as Cristina said. There are several ways. This is a model that is used by the EIB to assess the portfolio risk at the bank level. Okay, and it's basically standard for those of you that are familiar with this. Decomposes into physical and transition. But then now it goes down to very deep levels on what are the energy rents and the renewables and the action plans that each one of the loan portfolio items has, right? And that's how you then. So it's a bottom-up model based on all these things, on all these different aggregations of risk, just as an example. Okay, so moving ahead. Very good. So the official launch of the book is now. So this is the official launch. This is the moment. If you want to know more about the book, now it is officially available. I'm the only person, well, up to this week, I was the only person holding a copy. Now it's officially available. If you want to know more, here is the link to the book's website, and you also have the QR code that I'll put the QR code back in the future in case you're interested in knowing more about the book. Just to notice, there's 60% off for the next 10 days. Okay, so the next 10 days, the book is substantially reduced in terms of price relative to the normal price. So you may want to take advantage and be fast to move on it. Second thing I wanted to say is about connections, okay? And you may look at many, and you're here because you're interested in the topic for sure. I'm passionate for sure about the topic as well, and that's why I've spent several years of my life writing this. And I hope that with this panel we have sparked your interest, and I've sparked your interest as well, and that you've taken some useful insights for you and your organization. Because we all think about ourselves and our organizations, how prepared we are for this gigantic transition, which requires a bit of mindset shifts from leaders, investors, and even faculty members. So I'm passionate after many years in this topic. Most of the other speakers here are passionate as well. And I'm passionate about sharing the word and helping any one of you that would benefit and need to know more. So if you or your organization wants to have any deeper conversation, please connect. That's something I would invite you to. If you're a faculty member, because I saw that there are many faculty members here in the audience too, in the books, in the website, in this website here, there is more material available. The book is very suitable, as many other people said, to use as a main reference in a course, either in degree courses or corporate corporate executive education. I know of a leading investment bank who is going to use this in internal training programs, for instance. I would love to hear from you as educators how you plan to use the book, and if possible, I'm available to share additional materials, okay, with you as well. So just get in touch, connect. I'm working on a number of case studies on this topic, expanding on many of those already in the book, so then can share that with you as well. Slides, I don't use slides that much in most of my teaching, but I'm happy. But if you adopt the book, I'm more than happy to share any slides I have with you as well. So, I mean, just go to the book's website in case you're interested. You can get the full introduction, table of contents, and you see whether this is relevant or not. All right, so as we come to the close, I want to tell you who wins the award. Well, not tell you who wins, because we'll still have to look at the closest one with a very precise algorithm, okay, which is not ChatGPT, is a precise algorithm who is going to look at all the answers and come with the most precise one, most timely one, so I'm going to just show you the results. Okay, and now the chat is no longer valid, so the answers are no longer accepted. 71 real cases from different companies, products, financial products, or investors. That's the winning answer. It's 71 case studies and 87 exhibits when you add the 40 tables and 47 graphs. Okay, so this is the answer to this, and this gives me the opportunity to thank my research assistants, Filippo and Brenda, who were amazing support to gather all this data, put it in a tabulated fashion, also get the reference list for all the chapters, all these references, which is already a trimmed down version from the more than 1,500 papers that we analyzed for this book. This is really all you need to know and curated reference on the different topics. And I would like to appreciate not only the 80 contributors I've talked about before, practitioners and academics, but also my wonderful team of research assistants that really helped with this. We will contact you if you're the winner later on, and to get to your address, and you will get, as promised, a signed copy of the book. All of you others, even if you don't win, you can be winners if you share photos, okay, with me at least, and then I can use them in my website or something. I mean, some people share photos of my prior books like this, annotated and things like that. That's fine. I like to see that the book is used and it is not just in a shelf. That's okay. But a picture like this does not get you any award, okay? Now, I'm looking for more interesting pictures of you taking the book to Angkor Wat, okay? This is done already, but taking the book, Climate Finance book, to an interesting location around the world. Well, don't burn it in the fireplace. That's not the idea of this picture, is not to burn in the fireplace. But take it to an interesting location like Mount Fuji, the Egyptian pyramids, or Angkor Wat. If you do that, take it with you. If you climb Mount Fuji, I mean, look, if you climb Mount Fuji with a book on your backpack, and you take a photo at the top, for sure, I'm going to recognize you and I'm going to give you an award. Most likely it's going to be another book that you don't have, or something like that, or a dinner or something like that. So just encourage you, share any kind of photo in interesting places for my album. And with this, we get to the end of our talk, of our webinar. Thank you so much, all of you, for your presence here. Above all, thank you all the speakers for the fantastic insights that they brought, and complementing, very complimentary, each one of them. Available, here are my contacts, the link, and if you want to know more, just reach out, engage, and get, of course, a copy of the book. Thank you very much, everybody, and au revoir. Thank you.
Thank you, Nuno. Congratulations again.
I pass the floor to Marco now.
Congratulations.
Thank you. Congratulations.
Marco, the floor is yours.
Oh, yes, I have to say some closing words. So I think my main takeaway is that everybody's gain here, intellectual gain, is Lego's loss. So, but as Patrick says, there are positive things coming out of COVID. Now, I have one other remark for you, Nuno, but before that, I would just like to advertise that ECGI, you're not the only one to work on these topics. And ECGI launched in the fall a new project on responsible capitalism. And I see your book very much as part of that broader effort. And I think you briefly mentioned, that capitalism is with us, but that we can do better. And I think it's not easy. I also like something I like about your book. You called it this, I think it's maybe unkind to Stevie Wonder, but the Stevie Wonder approach is that there are no trade-offs and you can get, alpha from this without risk. I think is something that I personally share, and I think many others in the network as well. So I put the link to the Responsible Capitalism project down there. Follow this lead. And then my last remark and my challenge to you, Nuno, is that you've challenged people to send pictures of where they take the book. My challenge to you now is that we want to see a photo of you where you reproduce with Lego the title page of your book. Okay, so that's my challenge to you, and I look forward to posting a picture of that Lego model on the ECGI website. So thank you very much, also to the panel. As usually, I think we all learned a lot, and that's what another aspect of COVID, that we now have this technology and people know it, so we can bring together these groups and have these seminars at quite short notice. And it's all, it was once again super interesting. So thank you very much.
Thank you. Bye-bye.
Bye-bye. Thank you.
Thank you. Bye.